in chiropractic. He's obviously married to Dr. Brooke Stillwell. He's been in chiropractic most of his life. He gets into that story. But Ken's the CFO and COO of a publicly traded billion-dollar tech company called Pegasystems. And so Ken's insights for what he does there and how that applies to chiropractors scaling their clinics. We also talk about private equity, when's the right time to bring on money under your business. We even get a little bit into AI and how Ken sees the best applications currently for chiropractors. This is a really fun masterclass. You guys are going to enjoy this one. All right, everybody, welcome into the UAC Masterclass with, I think, one of my favorite members of UAC is Ken Stillwell. And a little background, I don't think, Ken, you haven't been out to an event in a hot minute, and so there's a few people that might not know you. So what's interesting about Ken's story to me is Ken is not a chiropractor. He is the COO and maybe CEO too, I'm not sure, of Pegasystems. Are you the CEO now too by name, by title?
COO and CFO.
COO and CFO, sorry about that.
Yep.
Pegasystems is a very large publicly traded tech company. So Ken has a very different lens than the rest of us. But Ken's wife, Dr. Brooke Stillwell, is a chiropractor member of UAC, and Ken met Brooke and her friend group at Palmer, which happened to be Dr. Eric DiMartino, Dr. Mark Mao, Dr. Lynn Mao. So the stories of you traveling out to Palmer when they were in school on weekends as you were out working, but they were graduating are epic stories, Ken, and always some of my favorites. But you've been around chiropractic as though you went through chiropractic school, I think. And so you've got this really cool lens of, chiropractic, you know what it is. You guys, your wife ran a practice for many years. And, but then you're in this tech world, you're giving financial reports to investors, institutional investors. And it's just always fascinating to me, the lens that you have and how you look at things in chiropractic. And so the title of this is this venture capital kind of a thing, and there's so many in UAC right now. There is this buzz around, how do I scale my business? And there's a lot of people in UAC. The average business is doing 4 million now. We did over 400 million collectively as a group last year. So this exit conversation is real, but then there's also a conversation I'm hearing equally as much as, well, what if you build it not to exit, but just because it's a great business that you want to hold on to? And You always have insights. Also, I'll give some background. Ken helped us set up the angel investment leg of UAC, where we funded businesses, and you sit on the kind of board of I Help Moms with the Browns that we raised money for. And so, Ken, I know that I just covered a wide range of stuff, but I wanted to just bring all the listeners that don't know you up to speed on kind of who you are and your background and what we've done together. But where's your brain land on all of that? What do you want to talk about?
Well, I think it's interesting. You touched on, my wife Brooke, who's a chiropractor. Her father is actually a chiropractor as well, and a number of his siblings. And so I grew up under chiropractic care before I ever knew Brooke. I mean, quite frankly, really where I really didn't even know Brooke's family, but when I had an injury when I was earlier, I had a basketball injury. My family was, I would say they were a little bit more kind of non-traditional in terms of healthcare, and we weren't as quick to run to the doctor. Certainly I wasn't as a child. Yeah. I didn't really know what that all meant, except that just didn't feel right to me. And so when I had an injury with my knee, I actually went to Brooke's father. I was probably in middle school, maybe ninth grade. And so there's been actually a long relationship between our family, and then Brooke and I ended up, subsequently dating and getting married and having 3 boys. But when I was at Palmer, as you mentioned, I probably spent more time in the clinic than any of the doctors because I was the adjustment dummy, right? Like I would go in and get everybody their adjustments. So, Mark would get adjustments, Eric, whoever was available, I was there because I was living in Iowa for about half the week because I was traveling with my role and I stayed there. So I was in the clinic quite a bit. So I'm
Oh,
actually,
that's
and I
funny.
actually went to I actually went to, a number of lyceums and a bunch of classes. And so I definitely, I definitely feel like I understand a lot about the the value proposition and the industry, and then being around all of you guys, I've learned about the business model a little bit more, right? And
Yeah.
some of the challenges. So I think maybe an interesting theme that we could talk about might be this dynamic of of the concept of you're a business that's reliant on yourself, right? When you're small, and then you try to make the business less reliant on your own
Hmm.
hands and the ability, because as we get older, you want to create value, and the value is just connected to you, then the value is only as valuable as your ability to be in the office. And that
Yeah.
is the same in business, in other businesses too, right? If you don't build a good team and you don't do the things to help the business scale, you're very dependent on a small number of people, like key people, and businesses tend to hit thresholds where they can't get to the next level, which is the biggest problem entrepreneurs have, is that entrepreneurs typically do so many things well, but not at scale. So they end up being really good getting a business to a certain point, but it's the rare entrepreneur that can take a business from 10 million to 50, and even more rare to take it from 50 to 100, and quite frankly, very unique to take it from 100 to a billion. That's why you don't see many people like, Bill Gates. There aren't that many, or Mark Zuckerberg. We see them, but we don't, but it's very uncommon. Like if you look at the number of companies that
Yeah.
have their founders, we could name probably on both hands the number of companies that actually still have their founders.
And
Everyone else
and Ken,
transitions.
if I
Yeah.
remember right, you're still working with your founder at Pega, right?
Yeah, actually, the company that I'm at, our CEO, Alan Treffler, who was the founder of Pega, he's actually been the CEO since he founded the company in 1983. But once
Wow.
again, super rare that can happen. Well, because you have to have the combination of the you have to live long enough to be able to do that, right? And he started the
Yeah.
business when he was like 24, right? So like he started the business very young, but also you have to have the same interest and passion level. And many times the monetization piece is a piece that trips people up, because many entrepreneurs start businesses to have the liquidity event, to have an exit. And
Yeah.
once your financial profile changes, your passion level sometimes changes. Now, that's not the case with my CEO, or with all the names I mentioned before, but like you even saw people like Jeff Bezos. I mean, clearly Amazon didn't light his fire anymore, right? Like,
Yeah.
and it was time for him to move on. It happens to the best of us.
Ken, can you just, this is public knowledge. What was the top line? Give some people insight. How much revenue did Pega do last year?
Yep.
Briefly touch on the industry you're in. And then what always blows me away is how many employees are underneath you and you're responsible for. Can you share some of that
Yeah.
data?
So we're around $1.5 billion in revenue, which for software puts us kind of in like the largest 100 software companies in the
Hmm.
world. We're growing like low double digits, kind of 10 to 15% growth. We've been growing that way for the better part of 35 years. So like it's been
Wow.
pretty consistent.
Yeah.
Our business is, we compete with companies like Salesforce and Microsoft. What we typically do is sell software to large companies like Bank of America, American Express, JP Morgan Chase, Elevance Healthcare, like companies that typically sell to consumers and have lots of transactions. So we have small numbers of customers, but very big relationships with those clients. And we have about little north of 5,000 employees, and about a third of those are directly in my I would say I'm responsible for. In my role, I view that all 5,300 are in my role.
Yeah.
I have to think that way, but in terms of like organizationally, it's probably just under 2,000.
So that's where, just the scale you're working at. And then let's zoom all the way down to maybe the typical UAC member who's still, let's just focus on somebody who's running clinics. And there's a lot of folks in UAC that have two, three, four clinics, or a small chain of clinics, that are maybe an average of 5 million of revenue, let's say. So they're the point to where the founders, the CEO, maybe they're still practicing a day or two a week, but maybe they're not.
Yeah.
But they're a long way from the journey you've been on. Where do you guide people? Where do you advise them to, they've gotten to that point where they've maybe proven it's not just their own job, but they're a long way from scaling this to even like say a joint, where do you direct, where do you see people get stuck in that mode? Where do you see the misstep?
So if you break your business up into a few components and you think like there's a component of like, the lead generation, so to speak, right? And then there's a component of converting those leads. And then there's a component of delivering the service. And then there's a component of like running the business. I'm just randomly picking just themes.
Sure.
What a lot of entrepreneurs or business owners really get wrong. So if you start with what's the mistakes that people make? The one of the biggest mistakes is that they think they're good at all of those. And the reality is nobody is. You might be okay at some, but you're always going to be able to find somebody better at a few of them. And the more that when a founder, I've talked to so many founders in chiropractic and in tech and in other industries, and the biggest connection point with success that I have determined from talking to them is the founder that says, I know what I'm not good at, and I need to find people to help me with that. The founders that say, oh yeah, I know everything, I can do it all, I'll figure that out, I'll Google it, I'll use Gen AI, those are the ones that I kind of know in my mind, like they're probably not going to make it to the level that they could. And you feel bad seeing that, but also sometimes people don't want to hear that, right? They want to believe that they're good at everything. So once you know what you're good at, and by the way, none of those, I just named 4, but split up your business any way you want. Once you know the 1 or 2 that you're confident, you love, you're passionate, you're good at because you get feedback from people, you're differentiated in that area, lean in there and get people around the other ones, the other pieces to really take those over, and then build the right operating cadence and the right KPIs and the accountability and the incentives for those individuals to actually drive those things. You will then get to a point where you realize, and this is really hard, this is where the best CEOs function, is when you realize that you're better off to do none of those things, but actually lead the organization and get the best people you can doing each one of those. And that's when you reach that point, then you've achieved what I would consider to be a real CEO, right? A CEO should really drive 2 things primarily, and other things as needed. They should drive the strategy, they should drive the culture of the business. And if you do those 2 things, I think you have to do. But CEOs don't have to do any of the other pieces if they get the right pieces in place. So if you think about that, drive the strategy, drive the culture, lean into the stuff you're passionate about, give up control and everything else, but with a trust but verify kind of approach, right? Where you actually have the right metrics, the right engagement. And I would say that's a very simple, like I said that in 60 seconds, very simple, super complicated to deploy. Egos, insecurities, trust, misconceptions, like it's just, that those things all seep into us as entrepreneurs.
Ken, one of the fun things getting to hang out with you is you see how money moves. There are institutional investors that invest in Pega and stock. You, as a financial person, have opportunities to invest in different things that come along in the world you're in. For the chiropractor here's what you just said, and they're at 3, 4, 5 million. So maybe they're looking at, they don't have maybe the margin to build that team yet. Even though they're at scale, they're still wearing 5 hats, and maybe they hear you, then they know they suck at 3 of them, but they don't want to spend the 250, 350, 450 to hire the A players that they could bring in, or they don't have the money, the margin. What's your advice on taking money in at that stage versus trying to figure it out and keeping it lean? Do you see the private equity, the venture capital as a time bomb, and they're giving up ownership and they're better to preserve it and figure it out and take loans or bootstrap it? Or do you think, no, you do accelerate it by bringing in the outside smart money? And where's your advice for a business kind of UAC size who's trying to make that decision of, do I bring investment? Do I not?
I think a couple things come to mind. One is I would advise, or I would suggest, that the owner really have some time thinking introspectively around what they want from the business. Are they 25 years away from having that discussion about being out of the business? Are they 5 years away? Are they 5 months away? Right? Where are they in that journey? And what do they think? I've talked to chiropractors. By the way, I've talked to small business owners that have an approach, which I'm not sure that I would necessarily agree with, but I would say their approach is that I'm going to run this business as long as I'm here. And if I'm not able to sell it later, so be it, right? I'll give it to my kids, or it won't work out and I'll shut it down. And I don't think that's I think that's a lost opportunity, but that's a perspective that someone might have. But if you're thinking about the business being an asset, if you think about the business as an asset, the analogy that I would use is, you have a house, and if the roof starts leaking and you can't afford to fix the roof, you don't say, well, I can't afford to fix it. You think about the impact of that water leaking and ruining the floors and you think, I can't not fix the roof, right? You have to kind of think, what do I want from the business? And then how do I think about the important investments that I need to make into the business? So let's jump to the point of, the business is an asset. I'm working in it now, and I want to sell it for something in the future. If that's the scenario, I want it to be worth something. I think that the concept of bringing in partners, money, or other senior resources, let's just say it that way, is really a decision that I think is around, how much risk can you take? If you need to live, if you are living in a certain lifestyle and you can't afford to bring in those resources, then you're bound by that. But there are other ways you can bring them in. You can bring them in with a profit sharing scenario. You can say, I'll bring someone in, I can't pay you as much up front, but maybe I'll give you some of the outcomes that you get. You could bring in a private equity firm or an investment firm to come in and buy a portion of the business to create some liquidity. I think the reason why I like the investment partnership aspect, and whether it's private equity, VC, or quite frankly, merging practices, or whatever the scenario is to get that, is if you don't have the cash flow to invest in the business yourself, and you believe you should, then I think an opportunity is to use someone else's money and someone else's leverage to help you. And the reason why I say that is the best decision that you can make is to create an opportunity where you and the investor benefit from the successful execution of the strategy. Borrowing from a bank or borrowing from someone that will have some collateral that then will want to come back and take your business, that's not a partnership, right? That's someone that basically, in the worst case scenario, they get some percentage of their money back. You want someone to be tied to the outcome. And many times these private equity type firms are very tied to the outcome. That's the reason why it could make sense. I'm using private equity as a general point.
Yeah.
But so if you're ensured that you believe you know the strategy, you know what can be achieved, you just don't have the capital to achieve it, then bringing a partner in, the partner that's vested in the actual outcome, that they're not going to make money unless this works, is a very good alignment. And I think it creates accountability for you as an owner. But once again, before you get to that point, you've got to be comfortable that you want that outcome that you're trying to get to, and that you're prepared to lose control, which is a really important point that I've talked to my father-in-law about this, is in the past, is, he's a sole practitioner, chiropractor. He really likes the concept of having it be his office, right? Bringing in new partners, people have other opinions. You don't have control anymore. So everybody has a different view, right, of what's important, and not a right or wrong. You just have to think about that. And I think what
Yeah.
you're talking about is you're a $4 million, $5 million practice, or you've got multiple doctors, you probably have multiple practice locations. You've
Mhm.
figured out how to get something to scale. Now the question is, can you get it to 50 million? You're unlikely to do that without bringing in some type of financial sponsor. At least unlikely to do that in a fast way, right?
Yeah.
It's harder to do that with speed.
So then how, the typical chiropractor doesn't know this world, and there's a lot of money in the sidelines right now. How do you help them kind of, there's some sharks, there's some people who would make great strategic partners. There's probably a lot of things in the middle. Any guidelines that you've seen for where do you start on that process? Where does somebody, how do they vet? What lens do they interview these different partners with? Any things you've seen in your experience that worked well or didn't work well from that perspective?
There are investment firms that have very deep domain expertise in certain business models.
Okay.
So first I would start with the business model. A chiropractor, a dentist, a cardiologist, a law firm. These are all business models that have similar traits, right? You're selling to a consumer typically. You have a large amount of value for the services that the person provides. You have some level of a third party reimbursement in some cases where there's so assuming that model stays, I think you could look at firms that have invested in business models similar to chiropractic. That's point one. That's at
Yeah.
least someone that knows the model. The
Yeah.
second thing that you want to do is you want to get your business. You want to have control over your business and how you talk about your business before you ever even talk to an investor, which means you've got to have all your retention metrics, your cost to acquire a client, so to speak, or your cost,
Mhm.
your cost to acquire, your customer acquisition cost.
Yeah.
It's commonly called CAC. Is something that you think you do. You have to have what's your long-term value? What's the value of a patient when I get them? How much does it cost? What's my retention rate? What's my margin that I make on a doctor? What's my over? You have to have all that together, and you've really got to not just have the data that you can hand a sheet of paper to someone. You've got to understand it so that when you could get to a point where you're negotiating with that company that knows your industry or knows the vertical, knows the business model. So you first have someone that knows the business model. You have your stuff together in terms of understanding all of your metrics and how you scale and how you make money and where you make strategic bets. Then I think you've got to screen some of those investors, assuming that you have the luxury of actually maybe having more than one be interested in you. You got to make
Mhm.
sure that is it going to be a cultural fit? This is think about this as a little bit like a marriage, right? You don't just say, I'm a man, I'm looking to marry a woman, and there's three women, so I'll just, pick whichever one, close my eyes and point at one. There's a courting process. It might be fast, but you have to actually say, this is a person I want to be involved in, whether that be values, whether that be the outcome alignment, whatever that might be. So I think there's step one, do they know your business model? Step two, do you have all the metrics to tell a really good story to get them excited? Step three, are they actually aligned culturally? Would you want to be with them? Think about down the road. Are you going to be happy 10 years from now that you're working with this person, right?
Yeah.
And then the last piece of that to validate that would be reference check talk to other investors, not just ones that they just did a deal with. Talk to people that they had a liquidity event. Try to find blind ways to actually find those people, not just through
Mm.
there, so that you can go on LinkedIn or go on social media and actually reach out. Hey, I noticed that you did a deal with. What'd you think? How did it work out? Why did you do it? To see how much alignment is there. So as much information gathering as you can, and then when that's all put together, I think the economics of the deal, and this is going to sound really counterintuitive to many people that are math driven like myself, but the math may work, but the culture may not. That's a failure. The math may not work, but the culture works. That's at least in play, right?
Hmm.
Because the math isn't it's not a binary thing.
Yeah.
Everything doesn't just happen like a spreadsheet. So I think if the culture works and the math is in a range, you can do that deal. But if the
Yeah.
math works and the culture doesn't, walk away.
Yeah, that's great insight, Ken. Quick pivot, just because you're in this world. There's quite a buzz in chiropractic, and everybody seems to have this desire to use AI in the clinics. And it seems like it's all about 80% of the way there. There's the bots, agents that can answer phones, but they don't quite integrate with the schedules. And when you hear them, you can still kind of tell they're AI. And one of the Chiro threads this last week was talking about a specialty clinic, like a pediatric clinic. You got to be careful because you got the parent of an autistic child calling, and you got an AI bot that's just too generalized. You can really mess up that relationship. Um, a lot of people trying to use AI on outbound sales when they're running different marketing, and they're using, platforms like Go High Level, and they want to quickly reach out to people.
Yeah.
Um, from your perspective, where you sit, for a small business like a chiropractor, brick and mortar, do you think it's a little premature? Do you think people need to be looking already at integrating that? Do you just have any insights into where that might go, where it is now? Is it a distraction? Is it an expense that's not worth it? Is it something they definitely need to start entertaining now so they're not left behind? How would you advise?
So one of the things that there are certain entrepreneurs and small business owners sometimes get caught on trends too much. So I want to start this conversation just with a cautionary tale of um, things like crypto and Gen AI and everything. Small business owners, typically the first thing they think is, oh, that's a get rich quick scheme, right? Like, how do I actually do that? I heard people were making, I heard people were buying $50 million mansions in Puerto Rico. I need to be in crypto. But the reality is you may know nothing about crypto and you may lose a ton of money, or you might make money. It's a gamble. And so Gen AI to me is not that. Gen AI is real. But I think it needs to be put in context. You mentioned 80%. I would say Gen AI right now is probably about 10% of what it will actually be when it's actually like fully manifested. What it's really good for right now, and in the context of probably the audience of who's listening to this, it's really good at like summarizing notes for your patients, or voice translation, or asking a question about a patient and going out and searching all the content of the data around that, and maybe giving you information about what might, instead of you going back through all the notes of a patient and trying to figure out, maybe it could give you a 2-sentence summary before the patient comes in that you could say, here's what's happened in the last 3 years with this patient. Those types of things, it's incredibly powerful, and I would encourage everyone to adopt as much of that as possible, because that is a real value proposition for Gen AI. The second one that I think is very real is on managing intake. Like, so that could be a question, scheduling. I need some information. So that could be enablement, learning, training, but also dealing with customers coming in or patients coming in. I think it's pretty mature there as well in terms of what you can do with it. Meaning I don't think it's going to change a lot from where it is in terms of that intake and how it can manage that engagement. So those are areas I would go after hard. I would just know that your audience, when I say I'm talking to chiropractors now, unless the nature of chiropractic becomes remote, there's a tool that adjusts you and you all do it through a bot. Unless that's the future of chiropractic, there is a personal aspect of the delivery of your service. And you have to think about Gen AI in the context of what the customer, client, patient wants from that experience. If they're going in to have someone lay their hands on you in terms of an adjustment, that is a little bit counterintuitive to have everything else be a bot. And so I just think you need to think about whether that's right for your practice. If you're in San Francisco or New York or more of a high-tech city, that might work. If you're in rural Ohio or Pennsylvania, where lots of chiropractors are, I don't know if that fits the audience yet. It might 20 years from now. So I do think that that's something that you shouldn't be. I have a rule, which is you should not be too far ahead of your customer. You should be a little ahead of your customer, but not too far. Because if you create too much of a gap, they can't get there. And so
Yeah.
I think about that as the analogy around Gen AI.
Yeah. That's great. Fascinating. We had one question come in. Chris, did you have that in front of you?
I do.
Could you, I think that was from Stephen Franson. Can you read that?
Yeah. Is it possible to classify large recreational flotation devices as legitimate add backs when calculating SDE for valuation in an exit, if my lake house is technically considered a corporate retreat center?
so I think the question is, how much can you intertwine your personal life with your professional life, right? And
In terms of a house, which I always heard was a bad idea, because you go to sell, you don't want your house wrapped up in the asset of the company, right?
yeah, so an interesting. So I would say I'm far from a tax expert, but I will tell you one thing you can do that is interesting. So you can use a property in the context of business. You can rent the property to yourself. You can do retreats. You can use that income against depreciation, meaning you can actually get a deduction from your business, depreciate the asset, offset that income that you're getting from your business. So essentially, you can shift income into the property. And then the question is, yes, but when I sell the property, I'm going to have, like, the whole depreciation recapture for those of
Yeah.
you that have owned real estate and all that. But what's interesting is if you have the two outcomes for how you manage that down the road. First off, you absolutely can do what I just said, which is take income from your practice, have legitimate bona fide business expenses through networking, community building, etc. at that property. You can create ways to get deductions of that. You will reduce the tax basis in that property, which then causes the issue you brought up, which is what happens when I sell it. What some people do is you can go and live in it as a permanent residence for 2 years, and then it changes the whole tax structure of it, which means it's now a personal residence. You get the personal exemption. You get more favorable treatment in terms of what you have to capture as. You don't have to do depreciation recapture, for example. There's a lot of things that change. The other thing you can do is you can do a 1031 exchange, which many people who've owned real estate, which is you can flip that property into a new one. Last point I would make, you can talk to people that are experts in trusts, because you can also move that property into a trust and avoid some of that negative tax treatment as well. So the first step in that process, though, is, can I use things that might give me personal pleasure as well to be able to leverage in the business? And you absolutely can. The problem comes later when you try to sell those assets. But I think there's even ways, and there's people I think that are even members of UAC that you could talk to about this. I'm not an expert on that, but I know enough to be dangerous.
Well, that's awesome, Ken. Well, it's just love talking to you, and love watching your brain float around. And thanks for your wisdom, man. We really appreciate you.
Absolutely, man. Great to be here.
That
Thanks,
was
man.
helpful. Good to see you, Ken. Thanks.